The dollar in your pocket is not wealth by itself. It is a promise that someone else will accept it tomorrow. That promise is the first link in a chain connecting your paycheck, your bank, the Federal Reserve, foreign governments, and trillions of dollars in debt. Once you see that chain, money stops looking like an object and starts looking like a machine built from promises. For much of American history, one promise sat beneath the others. Dollars could be exchanged for a fixed amount of gold. Gold limited how many dollars governments could credibly issue, because every new claim was supposed to point back toward metal held in a vault. The system sounded solid, but it carried a weakness. If too many people demanded gold at once, the promise could break. America ended domestic gold convertibility in 1933, although foreign governments could still exchange dollars for gold under the post-war Bretton Woods system. By the 1960s, spending on Vietnam and domestic programs sent more dollars overseas while America's gold stock kept draining away. Then came the first rupture. The promise behind the world's leading currency was about to become mathematically impossible to keep. On August 15, 1971, President Richard Nixon suspended foreign conversion of dollars into gold, an event remembered as the Nixon shock. The move was presented as temporary, but convertibility never returned, and the modern fiat dollar era had begun. Fiat money is not backed by gold, oil, or any other commodity. It is backed by law, taxation, monetary policy, and public trust. The Federal Reserve, created by Congress in 1913 after repeated banking panics, manages that trust by influencing interest rates, credit, and financial conditions. Its commonly cited 2% inflation target accepts that prices will rise slowly because policymakers fear falling prices and frozen spending even more. At 2% annual inflation, a dollar loses roughly half its buying power in about 35 years, even when policy works as intended. But the Federal Reserve does not create most of the money you spend, and neither does the printing press. Commercial banks create much of it with a few accounting entries whenever they approve a loan. Here's the hidden mechanism. The mortgage that leaves you owing money also creates new money inside somebody's bank account. When a bank approves a $300,000 mortgage, it generally credits the borrower's account with a new $300,000 deposit instead of moving existing cash from another customer. A 2014 Bank of England paper reported that loans create deposits, directly rejecting the simple story that banks merely lend out money deposited by savers. Textbooks often teach fractional reserve banking as a multiplier, where one deposit supports several rounds of lending, but modern banking usually runs in the opposite direction. Banks first make credit-worthy, profitable loans, then obtain the reserves and funding needed to settle payments and satisfy liquidity, capital, and regulatory rules. This does not mean banks can create money without limits, because defaults, capital requirements, funding costs, regulation, and central bank interest rates restrain them. When borrowers repay principal, the deposit money created by the loan is effectively destroyed, leaving the bank with its interest income. Your checking balance is therefore not a pile with your name attached. It is an IOU from your bank, supported by assets, insurance, regulation, and confidence. Inside one country, those IOUs move almost invisibly, but crossing a border reveals the machinery underneath. And this is where money becomes geopolitical, because control over the payment chain can matter as much as control over the currency. SWIFT mainly carries secure payment instructions, while correspondent banks hold accounts for one another and perform the actual cross-border settlement. A payment from Ohio to Turkey may pass through several institutions, each checking identities, balances, currencies, sanctions, and legal permission before the money arrives. That dependence explains why sanctions bite. SWIFT reported disconnecting 7 designated Russian entities in March 2022, while the U.S. Treasury reported roughly $300 billion Russian central bank assets immobilized. The dollar gives Washington unusual leverage because the IMF reported that it represented about 57% of allocated global foreign exchange reserves in 2020. I am close to the often cited 58%. The so-called petrodollar system is not one secret contract, but a loose structure in which oil is commonly priced in dollars and exporters recycle some earnings into dollar assets. Countries can trade in other currencies, but exiting at scale means rebuilding markets, reserves, payment links, legal protections, and trusted places to store enormous surpluses. China is testing another path through its reported ECNY pilot, while stablecoins offer private digital tokens that often reinforce dollar use because many are backed by dollar assets. De-dollarization makes dramatic headlines, yet recent IMF data showed the dollar's reserve share changing only gradually because replacing a trusted network is harder than criticizing it. Money is ultimately a story recorded in ledgers and enforced by institutions, but the only reserve beneath every reserve is trust. And next we follow what happens when that trust breaks.